Welcome to the next lesson. In this lesson, we talk about AI trading, algorithmic trading, quant trading, however you want to name it, but trading with mathematics, with an algorithm behind it, not just based on your emotions or just some lines on the chart, but on real data that you can implement in your strategy and use to evaluate if you want to enter a position with how much capital, with the right risk management, etc. So why we do that, of course, we will talk about that here, and I searched for new statistics because I think statistics are like really objective and telling the truth. They rely on data, as we also do with our strategies, because in the end, this is way more profitable, way more successful than just trading based on lines on the chart or any emotional problems we have with ourselves, etc. Yeah. So let's dive in. First of all, okay. On the left, you can see algorithmic strategies, and on the right, manual strategies. So the profitability of algorithmic strategies is 20 to 40% per year by algorithmic trading firms. On average, 20 to 40% per year. The Medallion Fund, the best fund by Jim Simmons, that gains an average of 66% per year, which is just crazy. This is really like the best you can see. This is the top. Okay, the number one trading algorithmic thing, whatever. Okay, like the best fund. While retail trading and manual trading just makes struggle to exceed 10% annually. So it's very unlikely that you even make 10% a year. So don't fall for that lie. Consistently, of course, this is way more consistent to have an algorithmic trading strategy, an AI trading strategy, instead of an emotional based, like if you have to do everything yourself, you are driven by your emotions, and this leads to inconsistent results, of course. The market share of algorithmic trading is 75 to 80% of stocks, while retail trading is only 10%. 5 to 10% of volume. Again, way lower. The risk exposure is, of course, way lower with algorithmic trading, manual trading way higher, because human errors, emotional decisions, etc., etc. The leverage used is often optimized mathematically, while you are in manual trading, use your overuse leverage, and this leads to an account blow up in the long term. Again, 80% of hedge funds use algorithmic trading, so the banks, like the funds, use algorithmic trading, and they don't trade mostly manual. The best hedge fund in the world is algorithmic based. Okay, this should already be the most important factor here. So there is no trader that is making, or the most profitable one isn't a trader that just trades manually, but an algorithmic behind. And the most profitable ones, the best traders, the best funds, are using some algorithmic strategies. Maybe they have developed them, but they don't trade manually. Again, 90% of retail traders lose money in the first year. Emotional trading accounts for 80% of losses. The average successful retail trader only achieves 10 to 15% yearly return, when even that significantly lower than top algorithmic strategies. Day traders manually trading stocks have a survival rate of less than 5% after 3 years. So 95% of you will go down if you just trade manually. So conclusion, which is more successful? Of course, algorithmic trading. This is just what ChatGPT tells, right? So it's objective. It's not my opinion. It's just the fact, okay? So you have to have, if you want to succeed in trading, you have to have a algorithmic strategy. So let's take a look. What is the difference between, or what is algorithmic trading and what is the bit difference to manual trading? So let's go to the chart. Okay, so manual trading could, for example, be something like, I have a gut feeling that I have to enter here because this is a good buying opportunity, and then somewhere else in the future I will have a gut feeling that I should sell my position because it's a good idea to sell here. Of course, this is not a good trading approach. Then, and this is what you learn usually in trading very fast, is that you need to have some kind of strategy that works for you and your trading style. And what you could do, for example, is you can use an indicator like the SMA applied to a chart, and then you could say, okay, when my strategy, when the close, the candle, the bar crosses above the moving average, I buy, and when it crosses below, I sell. This is already a trading strategy, and you can execute the orders manually or also automized as a strategy, but this is kind of already algorithmic because you are using key entries here and key exit based on facts, based on data. Very simple, but this is already algorithmic trading. So if you are using this kind of ideas, it's already going into the direction of algorithmic trading. What also some traders do, for example, manual traders, is they draw like trend lines, for example, like this. This could be a trend line like this. Okay, so this point and this point, like this point, you can see a rejection over here, and it goes down and then it crosses back up. So you could enter a position over here. This could maybe work, maybe for some trades, but this is just too basic. You don't think you can beat institutional algorithmic trading strategies that are based on so much data, on the smartest people, on the most accumulated money that you can find, with just a lot of experts, very good traders with expertise of 20, 30, 50 years even, that you will beat them by just that basic strategy. It's just not working. The same is for ICT concept, SMT concepts, is SMC, smart money concepts. It can work in any way, but usually it won't give you a real edge long term, because it's also very popular. If everyone uses the same strategy, it will just eliminate itself, because the edge, the more people the same strategy use, the less of an edge is there, and then the strategy won't work. Okay, so what we need to have, of course, is to have an understanding of is a strategy working or not, and how you can test it in two different ways. So you could do it like this, manually back test. So for example, we could say, okay, we buy here, right? This is the idea we had. We buy here, then we set a risk. This is usually used a risk reward ratio. We put that stop loss down here, and then we do it like a ratio of 1:1 or 2:1. We could also do like this, and then we could backtest this idea manually and do it for the last bars, and then just count how often we have won. Okay, this is what we could do, and this is usually done by most traders, and this is also why most traders lose money, because this is not really working. Because, for example, trend lines, ICT, SMC, smart money concepts, all of them are based more or less on subjective ideas. The same is for like Elliott waves. All of them are kind of subjective. Okay, Elliott waves maybe are not so subjective, but it's based on your own ideas. And this could be a trend line, like this could be one, this could be one, this could be one, right? You get my idea, right? Is the strategy really reliable and profitable? And the second thing is that just the backtest of 10 or even 100 trades isn't really saying much about the strategy, because I would show you what I mean. If we just add a strategy to our chart, for example, let's say any strategy here, like let's use the MACD strategy again. You can see that we had a total of 1,560 trades with that MACD strategy in that backtesting period, in that example SPX 1 hour time frame. And we can see it's not really working well. But in this time over here, right, if you just would see this window here, you would think it's the best strategy in the world. A high win rate, the equity is growing like crazy. You would think, wow, that's a great strategy. But it's actually not. It's not working well. Okay, we can do the same by, for example, I could show you this window over here. Let's try to find that. Okay, kind of like that. Okay, you get my point here. It's not perfectly fine, but you get the idea. So you see, oh, there's a good growth. We have a win rate of 50%. It's not great, but okay. Profit factor of over fear, which is very good. And you could think this strategy is working well, but actually It's not. Okay, you are slightly in profit, but we don't even have added the commissions and fees to it. So the strategy is basically not working, at least for this example of the S&P 500 in a 1 hour time frame. So what we need to do actually to find out if a strategy is working or not is to have a reliable backtest, which we can have here, to understand over a specific period and a lot of trades with a strict rule of entering and exiting positions if we have a market edge in the strategy, if the strategy is really working. And this is why we use algorithmic strategies that are based on facts, on mathematics, instead of our own ideas and feelings, because we can see that and then we can measure and then we can optimize. Okay, this is why we use it. And then if we see there is a steady growth in the equity curve, this means we have a reliable edge in the market and we can use the strategy and it will probably generate us profits for the future. Okay, I hope this was understandable. So what are algorithmic AI-based mathematical quant strategies basically? So basically what I just explained, and they are based on hard entries and exit conditions. Okay, so you use a lot of data, a lot of quantitative data, a lot of algorithmic mathematical calculations to create the most competitive edge in the market, to create entry and exit conditions that generate a good, reliable edge in the market, a good strategy that really works long term and has great results in the backtest. This is basically it. Okay, instead of just saying, I have to enter here because it just broke my resistance line over here, we don't use that. We could use that as well. We could use resistance lines, but then not based on subjective idea, but on objective entries and exit conditions. Okay, and this is basically it. And how to create a algorithmic strategy that works really good is by not being too basic, but also not too much. Of course, we have to have ideas, and then we test the ideas and see if it works, and then we optimize it based on a lot of data we can get. Like we could use indicators for entry and exit conditions. We could use like time factors. We could use crazy things like that doesn't even make sense. But if the weather is great today, we open a long position. If it's rainy, we close. Okay, this is also algorithmic. This is quant, big data, and this is what we use in our strategies and combine them in any way to get a competitive edge in the market. And this is basically algorithmic trading. So what's the comparison? What's the conclusion here? Manual trading will most likely don't make you successful. You will lose your money usually within a year or two. Very, very likely. You won't have an edge with manual trading. It's just too simple. It's just too subjective. You won't be a good trader when you use it. You need to have a reliable, consistently profitable strategy with a competitive edge in the market that will work for the future. And to have that, you need to backtest. You need to have hard entry and exit conditions that are not subjective but objective, based on mathematics, based on data, and then you can backtest it and optimize it. This is algorithmic trading, and this is basically what we offer. Like at Pine Indicators, we have algorithmic trading strategies that are available for everyone to use, basically, that are very well optimized, that are from experts, that are working well, that are not repainting, not lagging, etc., etc. Okay, I hope this was understandable. Again, if you have questions, please let me know, and we try to help you as soon as possible. Otherwise, we see each other again in the next lesson.